Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we've seen in global markets overnight. Stocks rising in Europe, while soft US labour data caused bond yields and the US dollar to fall. On Wall Street, the Nasdaq and S&P rising, boosted by tech stocks, while the Dow finished slightly lower. Shares of Alphabet surged after a court ruling which allows Google to retain control of its Chrome browser and Android mobile operating system, while barring certain exclusive contracts with device makers and browser developers. And shares of Apple benefited from that ruling. It has also preserved its lucrative payments to the iPhone maker from Google. Business software provider Salesforce forecasts third quarter revenue below estimates as clients rein in spending on its enterprise cloud products due to macroeconomic uncertainty. Shares of Macy's jumped 20% after the department store chain raised its annual forecasts, whereas discount retailer Dollar Tree fell heavily after the company forecast current quarter profit below estimates, with tariffs seen driving up costs for the retailer. And shares of US airlines lifted as oil prices fell. Well, here at home, Reserve Bank Governor Michelle Bullock has welcomed the rise in consumer spending as revealed in yesterday's stronger than expected GDP figures. Speaking in Perth last night, she said, "We are seeing it come back, and that's welcome. We're seeing the private sector start to demonstrate a little bit more growth now, which I think is positive. What it means for future interest rates, I don't know. All I would say, if anything, it's probably a little stronger than we thought it would be." Well, in the US, job openings fell more than expected in July and hiring was moderate, consistent with easing labour market conditions. The quit rate remained at 2%, layoffs at 1.1%, and the unemployment rate forecast climbing to 4.3% in July. And the Fed's Beige Book of regional economic conditions reflected economic uncertainty over tariffs, flat to declining consumer spending, was reported as wages fail to keep pace with rising prices. And FOMC member Christopher Waller has said we need to start cutting rates at the next meeting. And then we don't have to go in a lock sequence steps. We can kind of see where things are going because people are still worried about tariff inflation. I'm not, but everyone else is, he said. Well, US Treasuries have advanced, pushing their yields lower following the jobs data, which reinforced expectations of a rate cut by the Fed later this month. The US 10-year was down to 4.21%, the 2-year sliding to 3.61%, and the US dollar fell against the yen and the Swiss franc, the Aussie trading at 65.4 US cents. Bitcoin trading at just under 112,000 US dollars. Oil prices have tumbled ahead of this weekend's meeting of OPEC Plus producers that is expected to consider another increase in production targets in October. Brent crude falling close to 2.5% to $67 a barrel. Copper rose about 2%, iron ore up around 1% to $103 a tonne, and gold has extended its record-breaking rally on expectations of rate cuts and geopolitical concerns. Spot gold touching $3,576 an ounce. Let's get more on markets with a focus on Wall Street. Ira Epstein joining us again from Linn & Associates. Ira, let's start with those jobs numbers. Of course, a big week in terms of jobs data in the States. What are you seeing? And what's that telling you about the US economy?
Well, first, thanks for having me. Second, we have 5 points this week. You just had the JOLTS report. You're going to get Challenger Gray, which are the corporate layoffs. ADP numbers, which are the private sector, that'll come out tomorrow with Challenger Gray. U.S. jobless claims, that'll come out tomorrow. They're not looking for big changes there with the continuing claims. And then on Friday, we get the U.S. jobs report. So that's what you're dealing with. Let's just take them all and forget about any one number. The key is, do they show weakness as a whole? If they do, that gives the Fed reason to cut their interest rate. And the reason for that, am I saying it, is the Fed has said it's going to let inflation run. They think it's going to be cumulative. They'll accumulate over the next X amount of months. They don't know themselves how long, but under a year. And as it comes, they don't think it'll be terribly bad, and they'd rather err by letting inflation go up, but save the jobs market if the data comes in weaker. The JOLTS report, with a loss of about 176,000 offerings, shows that weakness. The turnover rate didn't do very much. So I look at the market this way. I think that in the U.S., number one, there's massive uncertainty. The lawsuits are enough to keep you. I went to law school. I can't keep up with them, all right? That's how confusing they are. It appears that anything this administration does, we are back to the first 4 years of the administration, where the Democrats sue them, or the states in this case sue them. They go to the Supreme Court. They either win or they lose. If they lose, they find another way to do what they're going to do. But that all creates uncertainty. And in this uncertain market, it's just been amazing that the month of August was an up market in the stock market. It's normally a weak month. And one of the weakest months of the year is September. So, yes, you should have caution, but not as much as you might think, because you have to go back and look at how many years do we have when in September the Fed could embark on what we'll call a multi-cut cycle that will begin. I, for one, don't think they'll go 50 basis points. I don't think they need it unless these next 4 reports that come out are really make your hair stand up. There's something wrong. I think that the Fed will do what the Fed does. They'll go gradual, 25 basis points, as long as this next data doesn't come in strong. If it does, then I'm in the camp there will not be a September cut. So I think tomorrow sets the stage for Friday, and Friday's the nail in the coffin, or you got to throw your hammer away and wait until October.
What are you making of that Fed commentary at the moment? As I mentioned there, heard from Christopher Waller. Also, we've heard from Raphael Bostic and others.
Waller wants to be Fed chair, so he's going to say anything that he can, hoping that it gets hold of the president, and the president sees that I'm the guy you want to have. That's how I believe it. He's been very vocal for a long time to cut rates. I don't think he was right when he was first calling it. I think the market's come around to him. But he is very vocal, and he's certainly one of the top 3 or 4 candidates for the job. Bostic is not in play at this point. A number of other people, as you know, are. They're just all over the board. And as I heard, Scott Bessent's going to begin the interview process, so we'll see what goes on. But what about that gold market? And I told you what I thought of gold, and it happened, Andrew. It exploded as my clients are jumping up and down, I can tell you that.
Yeah, all right. Okay, certainly following that tip from you, but are you expecting gold to continue to run given that uncertainty we're seeing at the moment?
How's that grab you? No. I think that it is now time that, as everybody's noticing it, you start peeling off parts of your position. The market's gone up to a big high number. You'd have to have some event come together that will make it go $400 more to the 4,000 level. I don't want to gamble on that just right now. So this is the area where you do a little peeling back and you have buying power on the brakes. Do not forget, you've gone up in the past 2 weeks, $200 an ounce. Markets don't go parabolic and stay parabolic. They go up and then they pull back and they develop another trading range from which they can move higher again if that play is still going. And I think it will be. But I'd be very cautious up here because you could walk in at any point to an $80 correction out of nowhere.
How are you feeling about energy at the moment? Oil taking another hit. OPEC Plus certainly seem committed to lifting production.
Yeah, between Sunday when I wrote my report, and it was like almost almost a certainty that OPEC was going to stand pat. Suddenly, some delegates came out on Monday and Tuesday and said, no, there's talk within the organization of increasing production again for October. Now, as you know, the IEA is saying that, wait a minute, guys, you're going to have too much oil. You're going to have a flood of oil. And OPEC has been at odds with the IEA. Do I think that they're going to increase more? I do not. Would I be surprised that they do? Probably a little bit, because why do that? You want to keep the price high. OPEC not only needs market share, but to make their budgets work, they need a certain price level. And they can say they're going to increase production. Then you've got to look at the actual amount produced, because telling a country they can produce more and they don't do it doesn't mean you're getting that oil to the market. You got to keep your eye on all those things. It's a little tricky.
All right, just returning to the equity market there, with a focus on those tech stocks. Now, obviously in the wake of Nvidia's report last week, it has taken a tumble, did dip below that 30-day moving average. What are you seeing there? And I guess also the other news being obviously Alphabet having that favourable court ruling.
Well, first, let's go to the Alphabet. What a wonderful ruling for them. They don't have to sell their Chrome. They have to share data in a certain way. They cannot pay to be exclusive, but they can pay to have their product listed still. And that's why you saw Apple go up nicely today. Besides that, for Apple, they also have a product launch coming up, and there's going to be a lot of new products. Whether they're the products that will set the world on fire, I don't know. When it comes to that, they need more AI, which they have been behind the eight ball on. In NVIDIA, it's owning the best of the best. It's like owning Netflix. When Netflix drops to 1180, markets like that, that gets me excited in them, because I see that as opportunity. Who's there to beat them? That's what I look at, and they have pricing power. I've been looking at my own bills come in. I'm starting to get increases again of a couple of dollars a month from the different ones that I have, and I'm watching my bill go up, but where am I going to go? It's still cheaper than going to a movie in the United States. That's the dilemma. The other part that you have with the AI is who's going to beat NVIDIA when their Blackwell is just getting its market share and they've got new products coming. So I hear people trying to beat it down all the time, and I view that as total nonsense from a fundamental point of view. From a chart point of view, they're in a correction mode. You don't need to be the first guy on the street to buy it cheap. You want to buy it when momentum turns back up. And that's the problem so many traders don't understand. When trading, momentum is often everything. Investing is different. On investing, you're not interested in momentum. You're interested in coming in on dips for a price that makes sense, be it earnings, whatever you're basing your investment on. So you've got to understand the difference between the two. You can be both, but understand what you're doing. Don't turn a momentum trade into an investment because it went against you. Let the momentum trade stand on its own.
All right, always terrific to catch up for our weekly chat. Thanks for joining us from Linn & Associates.
Thanks for having me.
Let's return to the local market where we're likely to get going. And it looks as though we're going to reverse that pattern we've seen to begin September. So SPI futures pointing up by 1/3%, and we'll get across that in just a minute or two.